continuing where we left off. Let's look at the second transaction. Cash takings total amounted for 4,000 for goods sold. The markup 25% was applied. Okay, so here is our clue. Something was sold. Once again, what was something bought or sold? You ask yourself. If something was sold, if you sold something, it's definitely sales. Whenever you sell it, and usually you sell your goods, right? Your business main goods. Whenever this is the main income for a trading business, basically, no? Whenever you sell something, your sales are definitely involved, right? And you get money in return as well. And now you ask yourself, what was the payment? What did I buy it with, right? What did I buy it with? With cash. Cash takings amounted at the total amounted to 4,000 of a goods sold. Okay, so it's basically mean that at the total after selling your stuff, the cash amount basically there it was 4,000 rand. Like you look at your amount, you're like, oh, it's 4,000 rand basically. No, so at the total, yeah. So yeah, you sold stuff, right? Sales. What did you buy for that sales? Cash, right? And whenever cash is involved, your bank is involved. No? Reason being is because you now receive money from selling stuff. Every time you sell stuff, you receive money, right? And if you received cash, like hard cash, if you received cash, it goes to your bank. You always, if you ever involve cash, bank should be one of the accounts. Always, whenever there's a cash payment or cash receipt, your bank should be involved, right? Always. And now, okay, so, and then cash takings, right? And then we're gonna see, there's gonna be another one. What was sold though? We can't just sell something and like it's nothing, you know. What was sold? It was goods that were sold, right? The correct term for goods in the accounting thingy is trading stock, okay? It's trading stock. And what goes hand in hand with trading stock? Or basically sales as well. It's your cost of sales. And why is that? Your cost of sales is what you paid for the trading stock. So these will always go together basically, right? Say I am a pen business, right? And I bought a pen for 5 rand, no? And that is the cost price. That's what I paid for the pen before I sold it. I paid for this trading stock, right? Trading stock meaning I'm gonna buy it to sell it again. So I paid 5 rand for this pen, okay? And I wanna sell it. Your cost of sales first of all is gonna be 5 rand. But you paid for the pen. Your trading stock is also gonna be worth 5 rand, because you paid for it, right? But then you're gonna sell it for a higher price because you wanna make a profit. You're gonna sell it for 10 rand maybe. That's your sales when you're gonna sell it, when you're actually gonna sell it. Okay? Then yeah. So your cost of sales will always be lower than your sales because this is what you paid for the goods and this is what you're gonna sell it for. And when you sell something, you also wanna make it a bit higher, you know, to make a profit. Okay? So these when there's sales, whenever it sells, credit sales or cash sales, right? It will always be 4 accounts. It's gonna be sales and either bank or debtors control, meaning they owe you debt. So if somebody, you sell goods on credit, right? If you sell on credit, say in this case you sold on credit and not on cash, right? Say the credit amount for 4,000 rand. So meaning they still owe you. When you sell on credit, you are the creditor now. You selling it on credit, right? Which means they owe you still money. Okay, and because they owe you money, they are in debt. That's why if they didn't actually pay you cash, the other account here will be debtors control, right? If they did not pay you cash, the other account will be debtors control there. Okay, because they did not involve your bank. Money did not come in your bank yet. They paid on credit, meaning they took your stuff and they pay you back later. Meaning money was not involved, right? So whenever it's bought on credit, it's gonna be debtors control in place of bank, right? When you bought on cash, it's gonna be bank because your money is involved. Okay. So yeah, but in this case, we cash takings, right? That's why it's important also to ask what was the payment, right? So you know whether you paid with cash, bank, or on credit, which will be debtors controlling. See, if they paid you, you must focus on what are they? Are they in debt by you? Because we're gonna keep journals of them. If they in debt, it's debtors control, they owe you money. But if it's creditors control, it means we owe them money. We are in debt, right? They are the creditor, which means they gave us the credit. But anyway, in this case, we sold goods and we got cash in return, so bank is involved. And whenever there are sales, there's always 4 accounts. Reason being, you sell stuff, definitely sales, right? You're selling stuff and you must get the income for it. So you're selling stuff, that's your sales. Then what did you buy it with? Basically, what did you sell it with? What did you get in return? In this case, you got money in return, cash. Cash involves our bank, okay? So bank is there. And then what did we sell? We sold trading stock, right? We sold goods. Goods is trading stock. What goes hand in hand with trading stock? Your cost of sales. Because remember, before getting those goods, you had to pay for it. You didn't get it for free. You had to, if you started a pen business, you had to pay for the pen first. Your cost of sales. So that's very important. There's a cost for the pen before you sold it for a higher price. But okay, let's get back. So our sales. Cash check is amounted to 4,000 ever goods sold. In your T journal, you're going to ask yourself, okay, sales, assets, owner's equity, or liability. It's an owner's equity because sales is an income basically. When we sell stuff, we must receive something in return, right? If you sell something, yeah, it means, okay, yeah, you must give me something back now. See? So sales is going to be income for the business. You get something back in return. So because owner's equity, remember, sales, okay, the debit side here, credit side here. Sales is an increase for the business, right? It's we receive money for it. It's an increase. We sell stuff, we must get something in return. And because it's an increase, it must be good on the credit side. For owner's equity, your credit side is your increases, right? And therefore we are gonna put plus 4,000 rand because our owner's equity increased with 4,000, right? And now in our bank, remember that 4,000 rand for cash, it went to our bank, right? We're gonna apply to the bank at the end of the day always. Bank, debit here, credit here. It's an asset, right? Bank is an asset. Now you're gonna ask yourself, assets increase where and decrease where? Increase on the debit side always and decrease on the credit side here, right? And because it increased here, okay, but let's see, did our money in our bank increase or decrease? Cash taken for goods sold, okay, for 4,000 rand. So because we sold goods, we got money returned, right? So it money is received, our bank becomes more, the value of our bank is more, right? Because once we sell stuff, in the total, it was a 4,000 rand, meaning, okay, we received 4,000 rand for selling the stuff, which increases our bank. So by our bank, by the debit side, it's going to be plus 4,000 because we received money. Okay, now we first focus on these two accounts. They go hand in hand. You sell stuff, you get money in return. Let's go here. What did, okay, now between these two accounts, sales, right? Is it sales and bank? What account was debited? Now you look under, okay, between my journals, but debit, credit. There, the bank was debited. You see, we put our amount on the debit side. So under the account debited, you are gonna put bank, right? And okay, wait, this is question 2.5.2. Let me just put it there to make sure you're not confused about what question it is. And this was 2.5.1. If you're just wondering, I got it here. Basically, yeah, like just to not confuse you, like what transaction you're working with. Okay, so bank was debited, and now we see, okay, what account was credited? You look in the T journals, you must also make a T journal, by the way. What account was credited? Your sales. Okay, so under account credited, we're gonna put sales. And now we're gonna ask, was our assets affected in any way? Yes, there's a bank. What happened to our assets? Let's see, it increased with 4,000 rand. Why did it increase with 4,000 rand? We sold goods, so we got money in return, we got cash in return. See, so like our assets increased, right? And then owner's equity. Let's see, was it any owner's equity here? Yes, sales. Sales is an income. Part of owner's equity. Basically, this is a monetary value of a business. Either the business receive money or give out money, income or expenses, or it's capital or drawing. It's either one of those, right? And sales is an income if you see the classification of accounts, right? We receive money for it. And how does sales affect our owner's equity? It also increased with 4,000 rand, okay? So plus 4,000 rand. Your liability, there was nothing we have to owe people, so it stays 0. Now we look at our other two accounts, right? Remember, what do we sell? Trading stock. And cost of sales is the price for it, no? Trading stock, it's always equal to liability. Trading stock is an asset, right? It's the goods we're gonna keep for a while. The business owns it until they sell it again, right? Then debit here, credit here, always debit and credit first side. Debit and credit. Now you ask, is cost of sales assets always equal to liability? It's an owner's equity, yeah? Because that's a money. This is now like an expense. It's the money you paid out for this goods. Remember, we had to pay the goods before we could have it, no? And that makes an expense. We paid money out, right? We paid out money, which makes it like yeah, it's, we're not receiving anything, we paid out money, so that's a bit of a decrease to our money, right? To our monetary value. That's your owner's equity. It's basically the money value in your business as well. But your bank is an asset because like that's exactly, and that's an account that you will keep. It's the what the business owns, right? But cost of sales is the money we paid out. Remember, we had to pay for those goods, we had to pay for the trading stock before we sold it. So this is definitely, it's expense, right? So by trading stock, now we're gonna ask, did our trading stock increase or decrease? We cash takings at the total amount for goods sold. You might think it increased, it actually decreased. Why? Goods was sold, meaning we have less goods now. So if our trading stock, so you ask yourself, the trading stock increase or decrease? In this case, your trading stock decreased, right? Where does it decrease? On the credit side. Okay, because as it increased debit side, decrease credit side. And there a decrease with how much? Wait, because these two go hand in hand. If you did not get the sales, right? No, if you got the sales, I mean, and it didn't give you the cost price, then you must calculate this, right? So now, how to calculate your cost of sales quickly? It will always be the amount they gave you, which was your sales amount, right? Your sales amount, and then times 100 over 100, always. And because cost of sales should always be lower than your sales, reason being, that's what you paid for the goods, sales what you sold it for, and your sales will always be higher because you want to make a profit, you want to have more money through selling it, right? And then your cost of sales, because it's lower than your sales, the markup will always be lower, right? And the markup here is it a markup of 25%. So plus 25 at the bottom, right? It basically means it's the sales. What was the sales amount? 4,000 times 100 over 125. Okay, and yeah. So if you calculate cost of sales, because cost of sales are lower, the markup should be lower. And when you calculate your sales, because your sales are higher, the markup should be higher. It should be on top, right? Remember that. Okay, so this will be 3,200. Okay, yeah. So our cost of sales. Let's first always fill in our cost of sales. We must first find out what did it cost for those goods. Our cost of sales was 3,200. Cost of sales is a expense we paid for those goods, so it's gonna go on the debit side for the expense there. No? So it's minus 3,200, right? Because we paid money out for those goods. And owner's equity, your decrease is on your debit side. Okay? Now trading stock. Trading stock increase or decrease? Like we said, it decreased because goods were sold. So it's going to be minus 3,200. It will always be the same with cost of sales. So minus, because look here, this is how much it's worth basically. We bought this pen for 5 rand. No? Your trading stock will be worth 5 rand before you sell it for 10 rand. No? So your cost of sales trading stock go hand in hand. The cost of sales what you paid for the trading stock. No? So trading stock and cost of sales will be the same price basically. Okay? And then of course you'll sell it for higher, just your sales. Anyway. So the 3,200, our stuff decreased, right? Our goods decreased because we sold trading stock. So 3,200 by the decrease side for trading stock. Okay. Now we go quickly to here. We go here. Now we see, okay, between these two, what account was credited and what account was debited, right? In this case, between trading stock and cost of sales, the debited side was cost of sales. You see, we record on debit side, right? Our cost of sales, it decreased our owner's equity, so it's on the debit side of the T journal. Anyway, cost of sales, debit side. So what account was credited? The cost of sales, right? And then what account was credited? Can you see? Trading stocks amount was recorded on the credit side. Sorry, it's untidy, but on the credit side, right? Trading stock amount was recorded there. So the account credited was trading stock. Okay. Now you see cost of sales. Okay, let's first go to assets. Did our assets were affected anyway between these two? Is any one of them an asset? You're gonna see yes it is. Trading stock is an asset, right? Something the business owns until they sell it. Did our trading stock increase or decrease? Let's check. A decrease to 3,200. So you're gonna say, how did it affect? So account equation, how your accounts were affected, how your assets and owner's equity and liability was affected. Okay. In this case, okay, our trading stock was decreased. This account we're focusing on now, and it decreased, right? Because goods were sold, so it will decrease our assets. Our trading stock decreases the assets now because goods were sold. Okay. Whenever, so we're gonna ask, was the trading stock did it increase or decrease? In this case, it decreased, so it's going to be minus 3,200 because goods have been sold. Owner's equity. Was the owner's equity here anyway? Cost of sales. There we go. Cost of sales is it an income or an expense? It's an expense, right? Where minus 3,200 because it basically took money from our business, like from the business money value. Liabilities, was there any liability between this two? No, it's 0, and that's how you do the accounting equation. And if you want to check if it's correct, let's just do, okay, bank and sales for example now. Bank was plus 4,000, it's an asset now. And then your owner's equity was plus 4,000, liabilities was 0. So you see, it will amount to each other. Your trading stock and cost of sales. Your assets, okay, we do these two accounts that are in line. Your cost of sales was how much? Okay, wait, what's first the asset? The asset was 3,200, a negative one. Owner's equity was also a minus 3,200. Liability was 0. And you see, it should measure up. It should be in balance. And that's how I do the counting equation. It's going to be a long video.